evening, everyone, and welcome to tonight's webinar, Medical Money 101, Your Early Career and Your Welfare Game Plan. We're glad you can join us this evening to go through this engaging session, specially designed for doctors and medical professionals. We have some great speakers tonight from Cutcher Neale, our Platinum partner, to take us through the presentation, who I'll introduce a little bit later. My name is Kathy Ball and I am the membership lead at AMA Queensland. But firstly, I'd like to do acknowledgement to country. We acknowledge the traditional custodians of the land in which we work and live. We pay our respects to elders past, present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. Just a few housekeeping notes today. The presentation will take about an hour this evening with plenty of time at the end for questions. However, you will notice that there is a Q&A area where you can place your questions in. We do have our guests muted tonight while we go through the presentation, but please put your questions in there and we'll go through them at the end. Please note that our partnership with AMA Queensland that we have with Cutcher Neale, our members do get a 1 hour free consultation with them. Everyone has different financial circumstances, and if we don't get through the depth of what you need, you can certainly take an advantage of this free consultation with our Platinum partner, Cutcher Neale. Before we get into the presentation tonight, we have a few events that are coming up that I'd like to go through. Our first one here is on Saturday, the 14th of March, our Medical Careers Expo, which will be at Voco Hotel in Brisbane. We will have about over 50 colleges, hospitals, and private operators that will be able to help you with career pathways and to get all your questions answered. We'll also have a panel that will have a live Q&A throughout the day, and this event is free for members. So make sure you get your registrations in for that. Our next event that's coming up is our much loved dinner for the profession. This will be held this year at Blackbird in Brisbane on Friday, the 5th of June. And then also we do have our fun and engaging educational junior doctors conference, which will be in Mackay this year on Saturday the 25th and Sunday the 26th of July. For our doctors in training, there are still sponsored tickets available for this, and they're valued at $600 per person. They cover the conference costs for the day and a half conference, attendance, catering, Saturday night function, and also they will contribute $150 towards your travel. To find out more about our events, please visit our events page on our website. Now on to the webinar tonight, Medical Money 101. We have some great speakers tonight. We have Sav, who is a partner at Cutcher Neale, and we also have Josh, a senior credit advisor at Cutcher Neale. What you'll learn in this 1 hour webinar is your intern year sets the tone for your financial structure. This session gives you the essential playbook for building long-term wealth from the very start of your medical career. You will learn to take control of your debt, master taxation, and salary packaging, accelerate your path to home ownership, and supercharge your super. It's a practical, straightforward financial guidance designed specially for doctors and packaged with opportunities that you can action today. Stick around for the end for a rapid fire session tailored to IMGs, covering deductible expenses, Medicare Levy rules, visa-related borrowing implications, healthcare requirements, health cover requirements, and overseas income considerations, plus have your questions answered live. The learning outcomes from tonight will be key early career financial decisions, confident debt and cash flow management, maximise your take-home pay through salary packaging, clear pathway to home ownership, boost a long-term welfare through smart super choices, know when to call in the experts. I'd like to welcome tonight Josh and Sav from Cutcher Neale.
Hang on, let's take over here. Over to you, sir.
Okay, thank you. Thank you, Kathy. Thank you for that kind introduction. So my name's Sav Angie. I'm one of the partners in the Brisbane office of Cutcher Neale, and along with my colleague Josh Holt, who heads up our finance team here in Brisbane, we're going to hopefully give you some useful information that can help junior doctors and IMGs lay the right foundations for financial success. So as a firm, we've been around for over 70 years, and we do a lot of work with medical professionals. We do training to different networks, and we have a dedicated specialist medical services division. We, as you can see from the map there, we have coverage down the eastern seaboard. Our client representation is obviously fairly heavily focused there as well, but we have clients all over the country. So with modern technology these days, it's quite easy to service clients all over the country without a problem. Some of our services there, so I'll be touching on a few of those tonight. Here's some top tips for our new doctors. Make sure you plan your foundations for your future wealth now. If you think you're too young to plan, then you're mistaken. Like you're basically at the right age. So here's some top tips. Lay the foundations for your wealth now. Start investing early. Structure your loans for maximum flexibility, and Josh will touch on that a little bit more shortly. Make sure you get your salary packaging right. For a lot of you, if you've only just started off as an intern this year, you may or may not have got your salary packaging in place. If you haven't done so, do so very quickly, because you're running out of time to get your first opportunity to get the $9,009 tax-free. It resets on 1 April, but make sure you get in and get registered now. Kickstart your superannuation. Again, not something that it's too early to do now. It's obviously something you can't access for a long time, but there's no reason why you can't start that wealth creation process now. And also look at ensuring your income. You are your biggest asset. If something happens to you and you can't work, then it will affect your financial future. This is where a lot of you are probably right now. As a junior doctor or an IMG, you've studied hard and you're now working hard. You've probably not got a lot behind you. You've got some credit card debt because you haven't been working. You've accumulated quite a large HECS or HELP debt. You're renting and making your landlord wealthy. There's not a lot of income just yet, but for a lot of you, the income is now starting. And so the plan is to try and build up some of those savings. In the middle of this diagram, where we say wealth, it's actually referring to you and helping you build and preserve wealth. We have a number of areas where we can assist. Income and taxation is just one of those. So getting your tax return done, future structuring for when you start progressing through your career, whether it's locuming or starting in private practice. Superannuation and financial planning. We have a wealth creation division that can help you invest money. Josh will talk about what we can offer from a finance and cash flow point of view. Risk and general insurances, so things like income protection, life insurance, TPD, trauma, and then as well as things like cyber insurance, medical indemnity, business pack insurances, home insurance, car insurance, and so on. Estate planning is also another fairly important one to think about when you start creating an asset base behind you. We're not lawyers, so we can't write wills or anything, but we can refer you to a number of lawyers that we work with. It's really important to make sure you've got those assets protected if something happens down the track. So with the right planning, this is what your future can look like. So fast forward 10 or 15 years down the track, and for some of you, there could be a family, there could be kids. You may have multiple entities. You're now a medical practitioner that can benefit from a high loan to value ratio, so you can start gearing yourself up and buying different properties. not just for your first property, but for subsequent ones. You can have a number of entities here as well. So you may have an investment company, a practice entity, you've got a family trust, your super fund owns your medical practice building, and then you've got multiple rental properties in addition to your family home. So this is just a bit of an example of the sort of things that are possible with the right planning. An offer that we have to our junior doctors is our Wealth Start package. And this basically includes getting your tax return done at a discounted price, and then access to all of the different services that we have on offer. So we can have complimentary consultations to discuss things like wealth creation solutions. We can discuss your salary packaging. Have you got it, tuned the right way? You're getting maximum benefit out of it. Are you doing the right thing with your super? Investment properties or buying your first home, we can certainly help structure for those as well. We have a deal on that at the moment. You're looking at about $1,500 worth of value. For junior doctors at the moment, $399, and that's whether you're a PGY 1, 2 or 3. If you're a member of AMA Queensland as well, then we'll also give $100 towards your AMA Queensland membership. And if you refer 3 friends, you'll get yours absolutely free. I'm going to hand over to Josh now to discuss finance and cash flow, and I'll join you again shortly to discuss some information about international medical graduates. Thank you.
Thanks, Sav. Hi, everyone. Bit of a different approach this evening as we look to both go through some early career financial structuring advice and also focus on some questions or some particular things to look out for those who are international medical graduate with some different requirements, both from a taxation and accounting and financial services standing. So it'll be a bit of a back and forth between me and Sav, but we'll try and cover off as much as possible in the time that we've got. So from a finance point of view, young doctors, whether they're international medical graduates or Australian citizens, but all have access to really strong lending policies to help with your first property or venture into the property market, and also potentially building a property portfolio, future goals in terms of whether that might result in commercial property or investing through different structures. There are strong policies out there to support you as medical professionals. These policies aren't generally always available directly from the banks, so it's important that you come to or turn to people who have access or know where to place you in terms of finding the right policies for you. Everyone's situation is different, so the best thing to do is to assess your personal situation, and then a discussion can be had to determine what the most appropriate maybe landing point is for you in terms of where to go for finance. So some of those policies may be just accessing higher loan to value ratios. So that means a low deposit entry point. And again, that may be for your first home. It could be for an investment property. It could be for commercial ventures in the future. No matter what stage that you're up to on your property journey, the financial institutions that we look to partner you with have options out there to ensure that you can access funding at a low deposit entry point. Maximizing borrowing capacity. So eventually you'll get to a point where you may have reached your limit in terms of what you can borrow. Everyone's got a limit, some are higher than others, but everyone will eventually reach it. But you might find that if you're going down traditional paths, that you're reaching that point sooner. So part of the analysis that we'll do for you is to look at options that make sure that you're making the most of what's available to you in terms of policies out there to get the best bang for your buck. Strategic funding arrangements, so that can be in terms of, again, partnering you with the right banks. So they might be a few options for that first purchase, which weigh up quite similarly, so nearly the same potentially. However, part of your thinking could be more long-term in terms of, if I've got a plan to get into a second property, will that funder support me or will they provide maybe the boost to get me into that second property sooner? That also can be in terms of will they also provide arrangements in the future that might be a bit more flexible to my needs that others might not provide? And if the difference there is only a small amount of interest rate, say 0.1% between the options, again, a wider lens might come into play in terms of what you're trying to achieve. And structuring advice, whether it's your first purchase, whether you're further along, you might have flexibility in terms of the amount of deposit that you hold. It might be in terms of what you're trying to achieve in extracting equity from a property, bouncing those plans off of us before you're going ahead with them. You'll be presented with options and you'll understand what the benefits are for those different options and allow you to make more of an informed choice. So high loan to value ratio, specifically as a medico, you have access to 95%, so 5% deposit. So that, again, doesn't matter if it's owner occupied or an investment property. It doesn't matter if it's your first home, if it's your second home. You have access to those policies that allow you to get into the property market sooner with a lower deposit. And if you're trying to build up equity in your home to allow you to support future transactions, then you only need to build up a small amount of equity to release in order to be able to execute that second transaction if it's all going to be held from a borrowing standpoint. So that this topic has been quite prevalent in the news this financial year to date as the government made changes to allow first home buyers across the nation to access a 5% deposit loan under specific circumstances, and those barriers were removed for a lot of those first home buyers. But the benefit for you as a medical professional is that you get that going from your first to your second to your third property. So you don't lose that access once property one has been secured. So I touched on borrowing power before. It's an important advantage that you have in terms of being able to access policies that allow you to borrow more than the average borrower. And there's quite a few different ones out there where on their own are strong, but if you can manage to roll 1, 2, 3 of these into the same application, then what you can achieve differs quite greatly if you go, rather than going down avenues where you don't have access to all of these policies at the same time. So for young doctors who are in the government health system, that includes future income projection. So quite simply, if you start out at PGY1, then your base rate from the day you walk in the doors is looked at from a PGY3 range. Queensland offers the strongest of all the states in terms of starting base rate income. So you're already ahead of your peers in that regard. And then being able to push up towards a third year rate within Queensland allows your base income from the start to be quite strong. The reason that you're allowed to do this, and again, if you move to another state, it's still available, just at the relevant level for that particular state. But the reason is that your incomes are quite clearly stated across the board in terms of what level you're at and what that translates to in terms of base rate, and your career progression is usually quite set, especially in those early years. Once you add overtime on top of future income projection, that's where you start to get quite a boost. So if you're up to a base rate 3 immediately, and then you're starting to work consistent overtime on top, then that starts to get your annual base income quite high. The advantage that you have as hospital employed doctors is that you get 100% of that overtime accepted from the bank's perspective as essentially base rate income. Most other employees, including doctors who are outside of the hospital system, don't receive that same 100% figure. Loan terms, initially we want you to pay off your loan terms as quickly as possible. We want your debt paid down and you're paying as little interest as you can. But there are policies out there that allow you to create a bit of flexibility in terms of how you structure your loan, and taking out a longer loan term up front reduces the cash flow impact of your monthly repayments. So it lowers them because it's stretched over a longer period. So that increases your borrowing power. Now, the important thing is that you're managing your budget and that you're putting more money away and building up potentially your offset accounts, for instance, because you don't want to be taking 35 or 40 years to pay off the loan, but you want to take advantage of the benefits of that upfront and being able to borrow more. The same applies to maybe later on, you may choose to restructure a loan and extend it back out again, purely for borrowing power perspective, not for the purpose of paying over a longer period and therefore paying more interest. This may not apply to international medical graduates, but from an Australian borrower perspective, the majority of you have gone through medical school will have quite significant HECS debts. So how HECS affects you from a borrowing power standpoint is that it's based on how much you're earning as to how much it affects you. It's not based on how much you owe. So if you owe 40, 50, 60,000, 100,000, 150,000, I've seen some people who have retrained in the low 200s, you're affected the same way because it's all based on how much you're earning. So the more that you're earning, the more the HECS is going to impact how much you can borrow. But there are policies out there that can help you reduce that effect. Usually you have to be closer to paying them off, though, for those to apply. And these are relatively newer policies. So, for instance, there's, again, as you can see on the screen there, one that is where the HECS balance is less than 20,000, it no longer applies, or if it can be seen to be paid off within the next year, even if it was more than 20,000, then again, it can be struck from it, impacting you from a borrowing perspective. Keeping on the theme of loan structuring, there is, again, a concept of you're about to take on a significant amount of debt towards a transaction and a purchase. Well, there's the concept of good debt and bad debt. So debt is there to help you in achieving your goals, and your goal is potentially to keep flexibility as much as possible with debt. So you want to minimize the negative effects of it, but maximize the flexibility in taking it out. So if you're able to generate tax deductible debt, then maximize where you can, whilst minimizing the impact that may be by using offset accounts, for instance. So tax deductible debt can be any debt that can be linked to either a business purpose or you generating an income from it. So for instance, a home initially when you move into it won't be tax deductible debt. That's your mortgage, that's where you're living. But your first home is generally never your forever home. You might upgrade to a new home a few years later and hold on to the initial property as an investment. At that point, you're then earning rental income on that home, and it's now an investment property for you. And then at that point, the bad debt has converted into good debt, tax deductible debt. So again, if we're thinking about our previous discussion about looking at deposit amounts, and if you're holding on to a bit more cash, potentially if you can utilize offset accounts and minimize the impact of the extra debt from an interest standpoint, whilst wearing maybe the cash flow of a bigger debt level from a repayments perspective, then keeping that higher debt limit for later when it becomes an investment debt is a good flexible option for you. So this is just a sort of snapshot from Christmas in terms of the housing market. So both units on the left and housing on the right is a national property clock. The markets can have peaks and troughs. So you can see there the clocks of tracking different locations throughout the country and where they're sort of going in terms of their property value and maybe the right time to invest. And the purpose of including that is that, especially for those of you who are maybe located in Southeast Queensland, especially where there's been such a big boom over the last few years in terms of property prices, the concept of getting into the property market for your first home may be becoming quite daunting, as those prices, at least during your initial years of training, seem unobtainable. So if you look at the property clock, it might make you think, well, there are other locations out there that are performing quite well. Then you may consider the idea of rent vesting instead. So that's the concept where you're paying rent, and it might be that you're still living at home as well and not having to pay rent. But in this example, let's just say you're paying rent, you're living where you need to, whether that's close to the the hospital, or if you're in the city or somewhere where you're comfortable and you're living somewhere for a lifestyle choice. And then you're still entering the property market, but maybe just in a different location. It doesn't have to be around the corner from where you live. There are well-performing locations interstate, and if this property is purely an investment for you, you don't need to have the attachment of going around there and seeing it. You just need it to perform well. Generally, it's difficult for especially doctors who are working longer hours, overtime, and you don't get much time off other than your 4-week allotment usually in those first couple of years. So you haven't really got time to keep your finger on the market in terms of what's happening from a property national standpoint. But depending on your capital that you're holding, you might find the benefit then of engaging, for instance, a buyer's agents. And there are buyer's agents out there who specialize in particular markets that might be outside of where you live. And whilst you can't keep track of what's going on across the nation, that is their job, and they can present to you some pretty good options in alternate locations that you might not have considered. They'll perform well over time and become something that you can utilize later for your next transaction, which then could be something for you to move into. I will just do a quick, example transaction of maybe what a first home purchase could look like. And we're going to use an example of 800,000 in Queensland. Stamp duty concessions in Queensland for established homes mean that at 800,000, the concession sort of disappears. You get a concession up to 700,000, and then between 700 and 800, it's tiered up until it doesn't apply at 800. So stamp duty would be 25,000. We've got a legal cost there of 2,000. So total cost to complete is 827,000 for this purchase. If you can borrow up to 95%, then you're hitting $760,000 and only needing to contribute 67,000. That's not necessarily nothing. So if you haven't got a good pool to start with, then you do have to build up to that amount. But in my experience, often there are other ways to try and get to that number, whether it's through potential family gift. There might be also some equity available in a family property that would allow you to borrow a little bit more to cover your deposit as well. But getting into the market and figuring out how you can get in there is allowing you to potentially ride some of the growth that the market's experiencing, where if we look at a 5% growth rate, that $800,000 property in 5 years' time is worth 1.02 million potentially, and your loan balance at that point has been paid down to around 700,000, and suddenly you've got 300,000 of equity to play with. In that time, you've gone through this 5-year step. You're at PGY 5 or 6. You're still accessing some of the policies. If you're still in the hospital system, your borrowing power is going to be much stronger, and you've got a bit of equity to play with. So worst case, after 5 years, you're in a very strong position to make that next transaction, and it's probable you'd be able to do so sooner. So I think we'll pivot back now to Sav and start to focus more on some of our IMG topics for tonight, but I'll be back with you shortly.
Thanks, Josh. Okay, so for IMGs, I just thought we'd cover a bit of a more specific area that if there's any joining us now, you'll probably need to know a little bit more information about, because the tax consequences are a little bit different. So if you're in Australia and you're getting paid employment, you need to apply for for a tax file number through the Australian Tax Office. The Australian tax year starts on 1 July and ends on 30 June of the following year. And so this can be a little bit different to countries such as New Zealand, Canada, USA. Their tax years can fall at different times. Everyone working in Australia must lodge a tax return at the end of the financial year. If you're in Australia on a visa such as a subclass 485, you're responsible for your own health costs, and you won't be eligible for Medicare Levy unless your home country has a reciprocal healthcare agreement with Australia. So if you're not eligible for Medicare support, you need to apply for a Medicare entitlement statement via Services Australia. So what does this do? When you're lodging your tax return, it exempts you from paying the 2% of taxable income that most other Australian taxpayers pay. It will also exempt you from the Medicare Levy surcharge if your income goes up over about 101,000 or 103,000, I think it is this year, and you don't have private hospital cover. So those of you that have got the overseas visitor health insurance, essentially that is funding your Medicare equivalent. It does not cover your private hospital insurance that's needed to avoid the Medicare levy surcharge, but that's where your Medicare entitlement statement kicks in. So ideally, once the end of the financial year is finished, if you don't have permanent residency and therefore not eligible to use Medicare, you need to apply for a Medicare entitlement statement. That is required when your tax return is done. Okay, to make sure that you do get that exemption and saves you the 2% of your taxable income, which can be obviously quite sizable. Tax consequences of, I guess, coming into Australia. So if you're in Australia for more than half a year, then you'll be considered a tax resident for tax purposes. So now this is different to being a permanent resident. So this is, I guess, a test that the ATO places on you earning your income and whether you pay tax here in Australia or not. Now, the other thing you need to keep in mind as well is you may have to include income from overseas. So if you come into Australia and you happen to have investments in another country, then what you need to keep in mind is that you may need to declare that income on those investment earnings, or whether it's an investment or whether it's a rental property or something similar. The earnings will need to be declared in Australia, but you also then need to keep in mind that it goes in your tax return overseas. If there is tax payable over there, you get a credit for it over here in the Aussie dollar equivalent. So people ask, what can I claim a tax, or what can I claim a tax deduction for, and what can't I claim a tax deduction for? So things that you can't claim a tax deduction for: cost of getting your visa to be able to work in Australia. And then people say, well, why can't I get that? Because I need it to be able to work. Well, that step, unfortunately, from the ATO's point of view, is considered too early in the piece in terms of being able to derive your income. So from that point of view, it's not specific to the job that you get, but it just allows you to be able to work in the country. Money spent on clinical observerships or elective rotations prior to getting your job are also not tax deductible. Once you've started working here, though, you'll be able to claim tax deductions for things like such as scrubs and laundry of your scrubs, your APRA registration, subscriptions to AMA Queensland, any study courses you do in your field of work to try and, I guess, progress your career or get a better knowledge to be able to earn more income going forward. Then we can also claim a work-related usage percentage of things like telephone, internet, computer, and then additionally stethoscopes, donations to deductible gift recipients, the tax agent fees for preparation of your tax return, and things like voluntary super contributions as well. And that's where you would then also need to complete a notice of intent if it's considered a voluntary super contribution rather than one that's been salary sacrificed or paid by your employer. Keep in mind that donations as well, be very careful with some of these. I guess a lot of people think that they can automatically claim a tax deduction for a GoFundMe donation, for example. Typically, GoFundMe is not a tax deductible donation. You need to check on the Australian Business Register that the charity that you are donating to is registered as a deductible gift recipient. They not only need to be registered as a charity, but they need to be registered as a deductible gift recipient. So that can be really important. People can spend lots of money on different donations, but then unfortunately be told when their tax return is being done that it's not deductible because the charity that they've made a donation to was not a deductible gift recipient, or they, were raising money as part of a GoFundMe page. Now, I mentioned the overseas visitor health cover before versus private health insurance. So if you're on a visa and you're not yet a permanent resident, you are responsible for your own Medicare equivalent. So you've got to take out cover, often with the likes of Allianz or Bupa or one of the other usual private hospital insurers. And this replaces your Medicare levy eligibility. So as I said, if you're employed, you have to have this cover, but then you need to apply for a Medicare entitlement statement so you don't get slugged at tax return time for the extra 2% Medicare levy. So if you're earning $100,000, your Medicare levy component is going to be $2,000. So you're already funding that through your overseas visitor health cover. So you shouldn't be paying that additional money. How do superannuation contributions work? Well, these are made up in a number of different ways. One is your employer. So as a Queensland Health employee, they will pay 12.75% of your base salary plus certain allowances and so on into your superannuation fund. In addition to that, you may also be salary sacrificing some super. So you may say, look, I want to put in some extra and ask your employer to withhold that whenever your pay is processed each fortnight, for example. And then additionally, you can make personal or voluntary contributions. You can make these at different times throughout the year. You can make them on a regular basis, or you could even do it just before 30 June and then claim a last minute tax deduction. Okay, so just some timing there, I guess. They're all treated in slightly different ways. They all have the impact of, I guess, like affecting your taxable income, or from a salary sacrifice and personal or voluntary contribution point of view. But they obviously help them with future wealth creation. So if you're an IMG and the plan is to then ultimately leave Australia, what happens to your super? Well, you do get access to it. So there are provisions in the Australian tax system called Departing Australia Superannuation Payment. Now, keep in mind that tax will be deducted from these, and there will be a final withholding arrangement. And it can vary depending on whether it's tax-free or taxable components. And the tax can be 35, 45, or even 65% of your taxable components. So that's a bit of a summary on IMGs and how the tax law, I guess, is a little bit different for them. If you do have any questions, please put a question in the chat box, or there'll be a QR code that comes up later that you can get in contact with us that way. But I'm now going to hand you over to Josh, who's going to talk about how IMGs are impacted by different borrowing rules. Thank you.
Thanks again, and thanks for your patience tonight as we cover quite a bit of information. I know it's probably a lot after a long day, but like I said, feel free to put any specific questions into the Q&A, or reach out to us as well. We're happy to talk more directly about your specific situations. For those who aren't permanent residents and have come across from another country, there's a few hurdles to get through in terms of borrowing. The landscape is not easy. So there's a lot of things to know, and it does come down to your personal situation, really. So we'll go through a bit of a high level of things to be aware of, but really, if you want more specific answers, it's going to be better off having a more personal conversation. So visa type plays a role. So depending on what type of visa you might have come across to Australia on, will depend on whether a bank will accept approving you for a loan immediately, or if you have to have progressed a certain way through that visa, or if you have to ultimately wait for permanent residency. And there are banks out there, though, that will accept you on most visas, but those are usually smaller banks, and they don't come with some of the policy advantages that we talked about already this evening in the other section. So it will come down to your personal situation as to whether it's maybe better off for you to wait, depending on the cost to enter the market once you start adding in the different costs that are charged to you as a potentially an international borrower. And whether the loss of the additional maybe borrowing power or a need for a bigger deposit because you can't get access to some of these other policies is enough to hold you back. Depending on your visa, if you are a joint borrower, that is maybe one way to get around it. So a solo borrower on that, maybe unfavorable visa, or two borrowers on those same visas will have more trouble than a borrower who's on that visa who might be borrowing in conjunction
with an Australian citizen or Australian permanent resident. Stamp duty costs, so the Queensland government will charge you an 8% fee if you're a foreign buyer. So that can be quite substantial. You still get access to first home buyer benefits. So whilst they're charging you 8% on one side, depending on what type of property you buy, you may still get some benefit from being a first home buyer and still going ahead with it, but you will get hit with that 8% cost. So FIRB, that stands for the Foreign Investment Review Board. So that is a body that's overseen by the ATO, and essentially they have to rubber stamp approvals of foreign buyers. They also made some changes in the last 12 months where if you are someone who's having to go through this FIRB process as a foreign buyer, then you're restricted in what you can buy. In the overwhelming majority of cases, you're going to be restricted to buying something that's new, that hasn't been built, lived in before. So it could be land and house package. It could be a newly built townhouse or unit that's available and ready to be moved into. But there is going to be a restriction on what's available to you. So as I already explained, that's what the FIRB stands for. And even if you're applying as a joint applicant with an Australian PR or an Australian citizen, then you still have to go through the FIRB process if you yourself are still a foreign buyer. And that doesn't matter how you structure the transaction. If it's 50-50, you could try and gear it all the way to 99% in the name of the Australian citizen and just have a 1% ownership. If you're connected to that property, you're going to have those restrictions and you have to go through that process. As I mentioned, it requires the purchase of new dwellings and there's additional costs. You're probably going to need additional legal support outside of standard conveyancing. That will probably be a little bit more costly as well. You want to be working with someone who's probably dealt with that before and isn't new to the process, because it can be quite costly if you don't get the right advice. The application fee that they charge purely to assess your application as a foreign buyer, regardless of the approval, is depending on the purchase price, but for instance, can be $15,000. So it's not a cheap process to go through. As I mentioned earlier, the stamp duty is 8%. What does that cost mean? Well, it may still be a benefit to you. If we look at this $800,000 transaction that we were talking about earlier in the presentation, then the same deposits required for the existing Australian citizen in that example of $40,000, and so the 5%. Let's say a international medical graduate was able to get approved for the same 95%, well, their deposit remains the same. If you were restricted by comparison as a non-doctor who hasn't been able to get a first home buyer approval and wanted to avoid lender's mortgage insurance, well, a 20% deposit means they're paying $160,000. In Queensland, that example, the stamp duty is $25,000, but we've also had to add in the 8% cost on top that I mentioned before. We're going to assume there's going to be some greater legal charges as more closer analysis of the situation, probably more involvement with that representative might be required. And as I said before, the FIRB application can be $15,000. So the comparison to the doctor who's not having to jump through these hoops versus an international borrower in that same transaction, the cost base can be very different. Like $151,000 is like an $84,000 jump from what would be otherwise required if you were already received your permanent residency. So hopefully that gives you a good overview in terms of some of the barriers and the hurdles. But as I mentioned earlier, there is a more probably specific conversation that needs to be held about everyone's individual circumstances, and we're happy to have that conversation with you. So feel free to scan the QR code. That'll also allow you to reach out to us and to maybe engage in terms of arranging a time to talk about your situation in more detail. So we're happy to have those discussions.
And if you have any questions tonight, you can also put them in the Q&A chat.
I believe we do have some questions.
Okay, I'm just in the slideshow, and then so we can run with that ourselves. Or did you want to do that, Kathy?
Yes, yeah, thank you very much, Sav and Josh. So we do have a couple of questions there. Can you just actually put back that QR code?
Of course.
You might have skipped through that a little bit too quickly. But we do have a first question. Could you please explain the benefits and reasoning of salary sacrificing and personal contributions?
Okay, salary sacrificing, I guess as a term, is where you take some money out pre-tax, so your employer withholds a certain amount of income to be then used for something else. So salary sacrificing is a fairly broad term, but as public hospital employees, you get the benefit of salary packaging where you can package up to $9,009 of what is typically non-deductible pre-tax items. So rent, mortgage payments, private health insurance, school fees, childcare, gym memberships, those sorts of things. And it comes out before tax, which then reduces your taxable income and has the effect of lowering the tax that you pay. So I guess a lot of people in different areas can salary sacrifice, but not everyone gets the tax-free exemption that public hospital employees get. And once you leave the public hospital system, you then lose it. From a super point of view, the employer pays super on your behalf. That typically is part of your overall salary package. If you decide you want to contribute more super, there's a couple of options. As I mentioned earlier, one is salary sacrificing. So you can say to your employer, hey, can you withhold an extra $100 a week from my pay and put it into my super fund instead? So the employer gets the tax deduction for that. Your taxable income is dropped by the amount of that withholding that then goes into super. So it saves you tax. The other option is you make a post-tax contribution. So after you've received your net pay into your bank account, you can turn around and then make a contribution to your super fund. If you then complete what they call a notice of intent to claim a tax deduction, then that is then claimed through your tax return rather than being done on an ongoing basis through salary sacrificing. So hopefully that's answered that question.
Okay, we do have another question here. You discussed several loan options. How does high LVR exclude you from the 35 to 40-year mortgage lengths and the more competitive rates? How much does age impact things? And they also go on as well, are these loans available through your banks directly or best to go with a broker? We are salaried hospital doctors. Is it best to get an accountant to prepare something, or do we just use pay slips?
Okay, there's a few questions there. I'll answer the last one first. If you're salary employed doctors and you're not earning income in any other capacity, for instance, some doctors might do some additional work under as a sole trader under their ABN or might have other income streams outside of the salary. But if that doesn't exist and we're just talking payslip income, then the payslips are all that we really need to verify your income. But you still do need, good accounting services for other purposes outside of just a loan approval to ensure that you're structuring things correctly and claiming the right deductions. So that's sort of a answer to that. The question about accessing the policies. So again, during that slide, I think I talked about the power of packaging those policies together and how it can really differentiate what's achievable for you. If that's what you're seeking to do and you're looking to get the best result possible, then talking to someone like myself is going to benefit you more than going directly to the bank. For instance, I access policies for doctors at banks where if they approach that bank directly themselves, the same branch manager or branch lender can't access some of those policies. They're exclusive policies. So they're designed to help you, yes, but
based on your personal situation, we can look at those and make sure that you're getting access to the best out there. I might read that question again because there was a question about interest rates in there, wasn't there, Kathy?
35 and 40-year loans, I believe.
Oh, so about 35 and 40-year loans. That particular policy won't exclude you from accessing a 5% deposit loan. So you can package those two into one. And the 35-year or 40-year loan term also won't exclude you necessarily from a stronger interest rate. You may find that if you're going for a 5% deposit loan, and depending on your circumstances, your interest rate might be 0.1%, 0.15% behind the best in the market. But if that is allowing you to maintain proper or advantageous loan structuring and loan flexibility, and you can see a clear benefit for that, then that sacrifice can be worth it. And if we look at, for instance, an example where you're getting into the market, you're making a purchase, and equity is growing in the property, well, your loan to value ratio might start at 95%, but as you pay some of that debt down, as the value of that property increases, we can revalue those properties, reassess your loan to value ratio, and improve your interest rate relatively quickly, considering how the property market's moving at the moment. I think that covered the whole question.
Okay, well, I don't think there's any more questions at the moment, but if you do have any more questions, yeah, please scan that QR code and reach out to Cutcher Neale, and they'll be able to help you, privately for your other questions that you do have. But thank you so much to Sav and Josh, and also that actually does take us to the conclusion of this evening.